Hi, this is George Huss with the 401k Owner's Manual. Okay, we've been through the foundation. In the last 9 episodes, we've talked about saving money. We've talked about what's in your 401k plan. We've talked about the bond fund safety myth. We've talked about the hidden truth about target date funds. We've given you some call-in training so you can send your own feedback. We've talked about how we ended up with 401k plans. And we've talked about the asset allocation myth. We've talked about fees that you're already paying inside your plan, and we've talked about the buy and hold myth. Now it's time to start having some fun because we're going to take some actual examples of funds that are typically offered in 401k plans. We're going to look at the top 5 equity mutual funds in most 401k plans. American Funds Growth Fund of America, Europe Pacific Growth Fund, Davis New York Venture Fund, Fidelity Contra Fund, and the Vanguard 500 Index. Then we're going to drill down into each one and look at the most widely held stocks in these funds. Apple, Google, Wells Fargo, Amazon, Coca-Cola, Microsoft, Oracle, Berkshire Hathaway, Comcast, and ExxonMobil. I'm going to cover each of the funds and the stocks in a separate broadcast. So here we go. I mentioned at the close of the last episode that I was going to reveal a form of investment analysis which has been used by Wall Street insiders now for over 130 years. It's called point and figure charting. History doesn't tell us when this method first came into existence, but it's known that Charles Dow, the Dow of the Dow Jones Industrial Average, used this method. Remember, this was at a time when publicly traded companies were not required to disclose anything about their operations, not even revenue. Charles Dow used this method to create a subscriber newsletter called the Communique, which was the predecessor of the Wall Street Journal. For you history buffs out there, I can recommend a free book you can find at Google eBooks if you like. It's titled The Game in Wall Street and How to Play It Successfully, and it was published in 1898 by an anonymous author whose pen name, cleverly enough, was Hoyle. The term according to Hoyle means in accordance with the highest authority. Edmund Hoyle was an English barrister who died in 1769, and he was the author of several works on card games, and he was and still is cited as the final authority when disputes on the rules of card games arise. So, in this episode, we're going to talk about American Funds Growth Fund of America and how you can analyze it yourself in a logical, organized, systematic way. The ticker symbol that we're going to use as a proxy for American Funds Growth Fund of America is AGTHX. That's Alpha Golf Tango Hotel X-Ray, AGTHX. For you visual learners out there, you can follow along on my YouTube channel. Just go to YouTube and search for the term The 401k Owner's Manual. Look for me, George Huss, and I'll be posting all of these to the YouTube channel as well as on iTunes. Okay, let's jump on over to www.stockcharts.com. That's www.stockcharts.com. This is a free website. There are other websites out there where you can get charts, but those are typically paid services. This one's free and it's fairly easy to navigate. Once you're on the landing page, you'll see a baby blue box titled Welcome to StockCharts.com. Just above that, you'll see a blue-gray banner on the cover that covers the width of the page. Inside that banner, you'll see the text Create a Chart and a drop-down menu with the default setting at Sharp Chart and a box which says Enter Company Name or Symbol and a button that says Go. Click on the drop-down menu. The next type of chart is PNF chart. Click on that, and then in the box that says Enter Company Name or Symbol, go ahead and enter the symbol of American Funds Growth Fund of America, which again is AGTHX. So now we're looking at a simple graph paper form. Down the left column and the right column, you'll see numbers from 35.0 to 14.0. These numbers represent prices. Across the bottom of the graph, you'll see numbers 01, 02, 03, 08, 10, 11, and 12. These numbers represent years. Inside the chart, you'll see columns that are filled with either X's, which are prices going up, or O's, which are prices going down. In some of these boxes, you'll see numbers 1 through 9, or capital letters A, B, or C. The numbers 1 through 9 represent the months January through September, and A, B, and C represent the months October, November, December. So the first thing we want to do is expand the chart so we can get some more detailed information. Just below the chart, you'll see a line with the following blue links: Instructions, Understanding, Print, About P&F Alerts, About Price Objectives, and Past Data. Just below that line, you'll see a box titled Chart Attributes. And that's where we're going to focus first. Look for the drop-down menu to the far right for Chart Size. Click on the drop-down box and find the size identified as Mega and in parentheses 1000. Click on that. In the next large box titled Chart Scale, click on the drop-down box for Scaling Method and select User Defined. Right next to the Scaling Method drop-down box, you'll see where you can change the box size. The default is set at 1. Change that value to 0.5. Skip down to the box titled Duration and the box titled Overlay Charts to the button that says Update Charts. Click on the Update Chart now. The first thing you should know about point and figure charts is they do not measure time, they measure price movement. It's a graphical representation of the battle between supply and demand. The most powerful thing about point and figure charting is it measures what is. It has nothing to do with predicting. It's all about measuring. It's measuring historical prices to determine whether supply or demand is in control of today's price movement. You can't fake supply and demand using this method because we're capturing the activity of real people using real money, voting with their wallets. Prices are rising or prices are falling. The only reason prices rise is because there are more buyers willing to buy than there are sellers willing to sell. The only reason prices fall is because there are more sellers willing to sell than there are buyers willing to buy. Any other reason given for the price movement is simply a story. Why? Because what would the media have to fill the space in the business news if they said, the stock market fell 350 points today because there were more sellers than buyers? Remember, the media is in the business of selling advertising. That's how they make money. The more views they have, the more they can charge for advertising. The way they get more viewers is to manufacture drama, and all drama is conflict. Create the most dramatic story with conflict. In other words, find somebody to blame and you'll get viewers. How realistic is it to believe some expert can pin a single reason, or even 2 or 3, for the market movement in a day? Getting back to the Growth Fund of America chart, focus on the high point, which is easy to find on the graph. Look to the top of the chart. See the X in the box above the capital letter A along the axis corresponding to the price of 34.5. Got it? Good. Now, reading the chart, we can tell the price reached that level in the month of October. Remember, A equals October, B equals November, and C equals December. Now, looking down that same column on the graph, and you'll notice that the bottom of the scale going across the column is between the 07 and 08. So that price occurred in October of 2007. Now, following along, shifting columns to the right, there's a B followed by 4 O's. What that's telling us is the price of American Fund's Growth Fund of America shares dropped in the month of November to $32 per share. And shifting over one more column to the right, we see that in December, designated by the letter C, followed by 2 X's above it, the price of Growth Fund of America shares rose to 33.5. Now it begins to get interesting. Shifting over one more column to the right and beginning with the number 1 in the column followed by 6 zeros and the number 3, we see that a significant change occurred in the beginning of 2008. Remember, we said prices fall when there are more sellers willing to sell than there are buyers willing to buy. Notice that from 2002 through 2007, every time supply took control, in other words, prices started falling, demand came back and the price exceeded the last highest price. To recap, the highs were $17 a share, $22, $28.50, $33.50, and $34.50. Each time there was a price pullback, the new low was higher than the old low, right up until we got to 2008. In 2008, not only did we not have enough demand to make a new high, higher than $34.50, but we experienced enough supply for prices to fall below the previous low of $32 and $31. By March, the new low was $29.50. For a point and figure chartist, what this tells us is the shares gave not one but two technical sell signals. What this tells us is supply has now taken control of the position. As we watch for further development, we notice in April and May of 2008, the price actually goes up from $29.50 to $33. However, in June, the share price reverses down before it could make a new high, which would have occurred at $34. This confirms that supply has taken control of the position and prices will likely fall. Does this mean that the Growth Fund of America fund managers were doing a poor job? No. They were following the mandate to invest in companies that appeared, in the opinion of the portfolio managers, to offer superior opportunities for growth of capital. The one thing portfolio managers cannot control, regardless of how good they are, is the general direction of the market, which will weigh heavily on any equity mutual fund. Unfortunately for you, even if portfolio managers did recognize a market move against them and the negative impact on the portfolio, they were powerless to get out of the way. Why? Because by mandate within the operating policies established for the fund at the time, they were limited in the amount of cash they were allowed to hold in the portfolio. They believed if you wanted more cash in your overall portfolio, you and you alone would liquidate their shares to raise whatever level of cash you desired as a defensive strategy. What could you have done? Well, the prudent thing to do would have been to have waited to see if the last low was exceeded, which in this case would have been at 29. And at that point, it would have become perfectly clear supply was in control and prices would likely fall. You could have avoided the decline in price all the way back to 17, where it was in November 2003. Remember, point and figure charts don't have anything to do with predicting. It's all about measuring. Okay, that's as far as we're going to go with the Growth Fund of America as a training tool. Stay tuned for the next broadcast where we'll be using Europe Pacific Growth Fund next. Just a side note, even if we're not using one of the funds offered in your 401k plan, you can still benefit by following along. The principles we discuss apply to all of them. That's it for today. Hope you've enjoyed this episode. If you have any questions, feel free to leave them on our Facebook fan page, the 401k Owner's Manual. You can always leave a review on iTunes or on the podcast page of yourwealthpreservationcenter.com, or you can leave a comment below this YouTube video. If you'd like a personal invitation to an online free live workshop, jump over to my sister site at 401kealert.com. Thanks so much. Until next time, I'm George Huss, and this is the 401k Owner's Manual.